Hello students, welcome back. We are having good gaps so that the topic, which is though very entertaining, but at the same time slightly technical, will be digestible to y'all. But at the same time, it is very important that when we are having breaks, you are in touch with the topic. So, yeah, so we are in this subject or topic, I can say, of capital gains, which is, I always use this word, an exceptional head of income. Why it is an exceptional head? Because this topic taxes a capital profit, or it taxes only capital profit. But having said this, what we discussed in first two classes, I'll again repeat, it is a misconception that all capital profits are taxed here. Answer is no. Only specific capital profits are taxed. So the first important point, I'm sure now you all remember and are thorough with this, is that all capital receipts are not taxed, because there are some other heads where capital receipts gets taxed, and even remaining all capital receipts are not taxed here. Only those capital receipts which fit in the charging section are taxed here. Yes. So only when you fit in the charging sections of this chapter, which is mainly 45.1, and then the other parallel charging sections, that is where you get taxed. Now 45.1, which is the main charging section, requires two things. And the past two classes, we have discussed in thorough detail as to what is an asset and what is a transfer. And Asha, what is the beauty of this topic? As I said, it is an exceptional head, which means that exceptional income is taxed under this. Plus, it also means that whatever you study, there will always be an exception. In fact, if you are studying a provision and if it does not have an exception, that itself will become an exception. I hope you understood this metaphor. So, this head is such that whatever you will study, you will compulsorily have an exception to that. That is the first golden rule of this. Now, this head says that again, the general provision given in the general charging section 45.1 is that whenever there is a transfer of a capital asset, it will be taxed in the year in which the transfer takes place. However, as per our golden rule 1, there has to be exceptions. So exceptions are that in some cases, the year of chargeability is not the year of transfer, it is some other year. So the general rule is taxability of capital gain should take place or takes place in the year of transfer, but with some exceptions where it takes place in some other year. And then comes the format. So when you have to tax capital gains, how it will be taxed? So the simple, though it appears to be technical, but only the language used is technical. In very simple words, what is the format? It is your sale value, which is called as full value of consideration, minus the expenses that you incurred on sales. Subtracting this gives you your NRV in the language of accounting standard. Here it is called as net consideration. And from that, you subtract both the cost. Since it is a capital asset, first is the cost that you incurred for the first time at the time when the asset is purchased, created. And then in future, if you incur any additional capital cost. So cost of acquisition, cost of improvement. So this is how this head format applies. Now, today is going to be an interesting session. In previous two sessions, we tried to consolidate our understanding about what is this head, when this head applies, what is asset, what is not asset, transfer, not transfer, everything. Today, our entire focus will be on the working part. That is, we'll be trying to understand each of these components by going to various provisions. See, there are some basic provisions which gives the main content of the format. But then, since this is an exceptional head, you will find many exceptions to them in various other sections. So today's session will be very interesting. You will study many things. Yes, I know it is slightly tricky to retain them, to learn them. But for that, I have devised some other mechanism. In next two classes, when we'll be dealing with the solving part, I will take you to those formats which I have devised specially for you, which will make your solving easier, faster. But today's lecture is more focused on at least knowing what are the various provisions relating to computation. Now, when it comes to computation, the first thing that you should remember is that the head says that your capital assets will be of two types, long term, short term. And how long term, short term is decided? It is decided on the basis of period of holding, where there are two rules, 12 months rule, 24 months rule. And then again, exceptions for few assets, they have to be treated as short term. Now, what is the difference between long term and short term? Basically, format for both of them is same. But when you go in detail of this format, you will realize that there will be some difference between the computation part if the asset is long term and short term. One main difference is of indexation, which anyways is not much applicable from last year's 23rd of July 2024, because from that date indexation as good as has been removed. And also there are some exemptions where the difference of long term and short term will apply, right? Now, before I proceed from here, I would like to hear from you all about your doubts, queries, if any. So yes, very good morning, everyone. Good morning, Linga R. Good morning, Navneet, Neeraj, Diya, Kuldeep, Teyasumi, Aditya, Dhanalakshmi, Tisha. Very, very, very good morning to all of you all students. So let me first hear from you all. You all were also supposed to read and come the provisions, the chapter. So tell me, firstly, if you have any doubts, queries, understandings, misunderstandings, before I proceed with the discussions of the day. Yes, students, over to you all. Okay, Neeraj says I'm waiting for question solving part. Good. Can wine barrel be considered as long-term capital asset? See, wine barrel, understand this. As far as I understand, wine barrel is used, will be used only in two scenarios. One, if I am a wine manufacturer, I'll be having barrel where I keep the wine after it is manufactured to keep it there for years so that it matures and becomes ready as a saleable product. Or second, which is very less, where let us say I am personally regularly consuming wine. I may be keeping a barrel in my house, in my office, or anywhere where I will be storing the wine. Now, in both these scenarios, the barrel, which is either kept with me personally in my house, office, or with a manufacturer of wine, in both cases, I understand that wine barrel becomes a commodity which is used for business. Now, interestingly, in the second scenario where I'm keeping the wine barrel at my house, understand it is a long-term use item. So definitely it will partake the character of asset. Similarly, in case of a wine manufacturer, where the wine barrel will be kept over years, and after, let us say, the first lot of wine is matured and prepared in that, again it will be used for the second time. So I believe over there also it will become the asset of the business. But interestingly, in this scenario, it will be considered as a current asset and not as a fixed asset. So this is my understanding. But where I am keeping it at my house, definitely it is like an asset. But again, the main point of differentiation will be whether it is a personal use item. Because we have read an exception, if it is a personal use item, it will not be treated as a capital asset and no capital gain will apply. Dhanalakshmi says, during sale of capital asset, do we get capital gain and business income? No, beta. See, if you are selling a capital asset, there will be only capital gain, right? There cannot be both. Yes, there is one special scenario, capital asset converted into stock entry. That is the only scenario where on the sale of that item, there will be two incomes which are attracted. But otherwise, the rule is simple. It will be only one income that will be invested, that will be attracted. The shares held company as investment in the name of some director. If sold, then company will be assessed to director. Kuldeep, I did not understand your query. Karishma is asking someone, please share the WhatsApp group link. Okay, that will be shared, Karishma. Fine. So, since your queries are now resolved, let me take it ahead. So we are in the computation part. In computation part, the computation is given in section 48, which says that while computing capital gains, now this is what is our format, but in literal, that is the theory part. In the section format, it says that while computing corporate capital gain, you have to deduct certain items from your full value of consideration. So first item is full value of consideration. From that, you deduct expenses on transfer, and from that, you deduct cost of acquisition, cost of improvement. Then comes the exception. What is the exception? That expenses on transfer, that is one of our items, you cannot deduct STT. If you remember, we discussed this. STT is what? Securities transaction tax. So whenever you are doing any purchase sale transaction through the stock exchange levies and collects this tax from you, called as securities transaction tax. You are not allowed to deduct this while computing capital gain. But interestingly, if you remember, I had mentioned this point also, that if you are a trader of securities and this STT is paid by you, then firstly, since you are a trader of securities, your income on sale of those securities will fit under PGBP head, and under PGBP head, STT paid is allowed as deduction. So students, you all should keep in mind that STT paid is not allowed as deduction when the share securities are held as investments and a capital asset. But if it is held as stock in trade and the income is falling under PGBP, STT is allowed. Then comes the point of inflation index. Now, as you can see, this date, 23rd July. Now, what is this date saying? Last year, there was this major amendment in capital gains chapter. And last year, this amendment happened in between after the budget post our election results. So as you all know, 2024 was our general election year. And in general election year, you always have two budgets. One on the decided date of 1st Feb, but it was a pre-election budget because that year, May, we were going to have elections. And after elections, after the new government was formed, we had the final budget. So we had two budgets last year. Now in the second budget, which is post-election results and which is the final budget, we had some very important amendments. One of the amendments was this, that capital gains will undergo a very big change when it comes to computation. Now today I'm going to explain you this point of indexation, though now, as I explained earlier also, that though now it is not very much applicable, but you will require it when we go to computation of tax. So I'm talking about cost inflation index, which is used here in the concept called as indexation. Now, what was your scenario pre 23rd July 2024? You have two assets, long term, short term. Format is same. Full value of consideration, FVC, minus expenses on transfer. You have net consideration minus cost. Correct? Now, students, you all have to be more attentive today because we are into a technical part of this topic where there will be many interesting but technical points. Now, let us say this is 100, this is 2. Now, let us say cost of acquisition is 50 and cost of improvement is 10. Now, if the asset is short term, you were deducting the cost as it is, and the difference was your short term capital gain. But if the asset is long term, you are not taking the 50 as it is, you were taking the indexed cost of this. So instead of taking cost of acquisition, we were taking indexed cost of acquisition, indexed cost of improvement. Now, what is this index cost of acquisition? Index cost of acquisition means, including index cost of improvement, both means that we adjust inflation in this cost. Now you'll say, sir, what is adjusting inflation? Pay attention. Now, students, in case of capital gain, generally what will happen that the asset that you are having is some old asset. Old means purchased some 5 years, 10 years, 20 years, 40 years ago. So let us say in this case, this asset which you are selling today was purchased in the year 2010-11. So right now you are in the previous year 24-25, right? Because we are doing computation pre this date. Let us say it is on 1st July 24 that you have sold this asset. So you are in the previous year 24-25. But the asset was purchased in the year 2010-11. Now please understand the logic of indexation. What is the logic? That this cost that you have paid 50 rupees, it may be 50 lakhs, 50 crores, whatever, was paid in the year 2010-11 for purchasing this asset. Now this asset, let us say it is some land, you're selling today, which is 24-25. Obviously, today's inflation and the inflation of the year of purchase, which is 2010-11, is definitely different. We all are seeing inflation is regularly increasing, because of which prices are increasing, which means that whatever was your cost in the year 2010-11 was at the old inflation rate. And today's price, whatever you'll get of the same land, will be higher. Why? Because the inflation has increased. Now, you are taking the sale price of today, which is as today's inflation. And from that, if you deduct the cost of 2010-11 as it is, then it will be unfair, because this difference between 150 may be because of inflation. So the law said, we will be fair, we will allow you to inflate this cost. We will allow you to adjust the inflation. How? You are selling the asset in 24-25. So take the CII. CII is what? Cost inflation index of the current year multiplied by 50 and divided by the cost inflation index of the year of purchase. Definitely the cost inflation index of current year will be higher as compared to 1011. I'll give you the picture also. So this was the cost inflation index. So 1011's cost inflation index, as you can see over here, is 167, and cost inflation index of 24-25 is 363. So what will happen? Now these are inflation, you can say, indexes or figures representing what was inflation. So if a price of something was 167 in 1011, the price of the same thing has become 363, virtually doubled. So I would multiply this 50 by 363, correct, and divided by 167. These are the inflation values. So when I multiply 56 by 363 and divided by 167, the amount which I'm getting here, let us say, is coming to 90 rupees. So 50 original cost has been changed to 90. What is 90? 90 is the indexed cost, inflated cost. And now when I subtract this, I will get my capital gain or loss. So this is the concept of indexation. However, from 23rd July, this indexation has been removed from the working of long-term capital gain, and hence today, our today's format says that whether it is a long-term or short-term, you will take the original cost only, you will not inflate it, you will not index it. So today's rule is that indexation has been removed. However, having said this, if it is removed, then why it is given in your module? Why something of 2 pages is written? Because when they removed this in the budget, there was a lot of agitation, protest by people. So government again allowed the indexation, means it brought in indexation, but where it first said that indexation will now not apply permanently from 23rd July onwards. So there will be no indexation post 23rd of July, right? However, after the protest, it said that, okay, we are bringing in an exception where we will allow indexation. But to whom? Only if the asset is individual HF and if the asset is long-term land or long-term building. So when individual HF has sold long-term land or building, they will be given an option, a choice that you do two workings. One is the working as per our new method, that is without indexation, and one is the working as per the old method, that is with indexation. Now, out of both, you will take whatever you find beneficial. Now you'll say, sir, everybody will find the old method beneficial because indexation increases the cost, so it will reduce the capital gain, right? But the difference is here. If you are going by the new method, that is, you are computing the capital gain without indexing it, which is the new method, then they said we will take tax rate of 12.5%. And if you are going by the old method, that is with indexation, then we will take tax of 20%. So this is what is the change. Now, in the current year, that is in our present year, where indexation has been removed, we will be solving all sums without indexing the cost. This point of option, which is given to individual HUFs, we are going to use, but that we will use only in those sums where tax computation is required. Because now the new format says no indexation. So while computing capital gains, you have to remember, even though you are individual HUF, even though the asset is land building, you will not index it. You will do it as per the current format, that is without indexation. Only when you are computing the tax, which is the last part after the entire computation, everything is done, when you compute the final tax liability, at that time, you will compare both these options. If you find tax liability is lower here, you will follow this method. That is, the tax will be paid as per 12.5% on without index amount. Or if you find this tax is lower, you will pay tax at the rate of 20% on the amount which is after indexation. So this is what is the position. So today we are going to start reading from here. Before that, I have, I think, some pointers in the chat. Let me go through that. Dhanalakshmi says, after conversion of capital asset to stock in trade. Dhanalakshmi, beta, please, we will come to that point. See, I can answer this point here, but it will be confusing for you also and others also. So please resist your doubt, because now what you are asking is a very specific scenario. If we reach there today, we will definitely study today, right? So let me go step by step, beta, so that others will also be able to understand. Pranav says, sir, if I'm a stock trader, then my profit is charged under PGP. Exactly, beta. Kuldeep is asking who will be associate director or company. See, Kuldeep, firstly, I'll request that please but even hypothetically, if I say, because you are saying shares a company, investment in the name of director, but you tell me you are also studying companies act, you are also studying accounts. Will it be possible? Because company is an independent entity, independent from shareholders and definitely independent from directors. So if something is in the name of director, how it can be, right? So if asset is in the name of director, I don't, voice is breaking, sir. Okay. Uh, ठीक है. I'll repeat. My video is still stuck. Okay. So, Kuldeep, I was saying that in your case, even if I assume what you are saying is happening, then in that particular case also, the law is simple. Capital gain will apply to the person in whose name the asset is. So if the asset is of director, capital gain will apply to director. I don't know how there will be, means I did not understand firstly practically how it will happen that the shares are of company, shares are of director held by company. How it will be held by company, that I did not understand. Anyways, now we are discussing this concept of indexation. So indexation basically means that since you are having an asset which is purchased 5, 10, 20 years before, the cost that you know of that asset, like in my example, 50 rupees, is of 20, 10, 11, which is 15 years before from today. Now, when you sell some asset today, you get today's price, which is obviously because of inflation, it appears to be high. And you are directly comparing it with the cost of 2010-11, which is unfair. So the old rule of indexation, which is now removed, says that that old cost of 1011, which in my example was 50 rupees, you will inflate it to bring it to today's inflation value. That is what is indexation. So Nagaraja, if you have not heard that, I'm showing this working again. So in my example, the original cost is 50 rupees of 1011. So you divide it by the inflation value of 1011 and multiplied by the current inflation value. So this will give you the inflated cost of this asset as on today's date, that is the date of transfer. So this is what is the ideology of indexation. Now this is allowed in this year only as an option. So what it says, only when you are computing the final tax, that is up to the computation of capital gain, indexation will not apply in the current year. Only when you are computing tax, then you are given an option of taking indexation value. This given to who? To individual HF who is resident of India, and only where the capital asset which is transferred, which is obviously a long term because indexation anyways apply to long term only, is either land or building or both. And which is acquired before this date, obviously, and it is transferred today. So if the asset is acquired before this date, now this is very important because if your asset is purchased after this date, that is after the date of this amendment, then anyways indexation will not apply even here also. So keep this in mind. Your individual HUF and you purchase the land after this date, that is the date of the amendment, then when you are selling the land, the option of indexation is not available. The option is available if the land was purchased before this date and it is sold today. And as I explained earlier, only when you are computing the tax, you compare both these taxes at the rate of 12.5% without taking indexation, at the rate of 20% by taking indexation, and then you can pay whichever is lower. So, very important for computing income under the head CG, which is included in your total income, indexation will not be done. So indexation, which you are going to do at the end only when you are going to compute tax. So even today, when we will be solving the sums, keep in mind, even though you are fitting in this computation provision of indexation option, you will not do indexation because indexation is not to be done when you are computing the capital gain. So while computing income and capital gain, indexation is not to be done. That you will do last when you are computing the tax, right? At that time only indexation option has to be exercised. Fine. Now some more provisions. Now students, one more thing. Here when I'm explaining these provisions, as I said that today we are going to have many technical points. Now out of this, some may not be relevant for your exams, but I'll be explaining since it is part of the module. But I'll inform you whether you need to keep in your memory side also, because certain things of this may now not be relevant for you, because as I said, many of these have been amended, and since these are past year amendments, now in today you only have to follow the current position, so all these past amendments may not be required. Now what is this provision? See, we are in the computation provision. Today we are going to only deal with computation. Computation means four values: sale value, which is called as full value of consideration; expenses, cost of acquisition, cost of improvement. Today, whatever the provisions we'll discuss, we'll be talking about these four scenarios or these four figures in different scenarios. Now, this is again, they are talking about full value. So they're talking about the sale price of what? Of shares, debentures, warrants. Okay. But it is a specific case. What is that specific case? That is where these shares, debentures, warrants were given to you by your company as a ESOP, and later on you gifted them. Now again, as you can read this provision is applicable only up to last year, that is previous year 23-24, relevant to AY 24-25. Anyways, we will be getting sums on previous year, which is 25-26, AY 26-27. So it is 2 years old provision and it is not applicable today. But just to inform you, if you gifted these items, which was received by you from your company as ESOP, firstly, this was the only gift which was taxable. Now recall, today gifting is not taxable because from this year the rule has changed. So gifting is no more taxable. Gifting of any asset is not taxable. But up to that year, gifting of only this one item was taxable, that is ESOPs. And since it was taxable, they had given the full value to be taken in computation. They had said that on the date of gift, whatever is the market value, that will be taken for computation. Then interestingly, there is one more important computation which is applicable to non-residents. Again, I'm explaining this, but let me inform you students, it may not be relevant for your exams, but this is again part of your module. So you need to know, it may happen that you may get it as a very rare question. So what is this? Let me keep it here only because it is not very relevant. what it is. Special cases of computation. Applicable to whom? Non-resident. But what is interesting in this is very limited provision. It is non-resident, but not only that you are a non-resident, it is interesting what the asset is. Asset is shares or debentures of an Indian company. So you are a non-resident. You had purchased shares, debentures of Indian company. How? By investing the amount in foreign currency. So this provision, this special point that we are discussing here, special computation, is applicable to non-residents who had purchased what? Shares or debentures of Indian company. But how? By making payment in foreign currency. Now, when they are selling these shares, debentures, so non-resident asset is a long-term capital asset being shares or debentures in Indian company. And what is important, purchased using foreign currency. Now, interestingly, what is the provision? Now see, whenever you are doing computation of capital gain, your format is very simple. Now what has happened? Let us say 10 years back, you are a non-resident who had 10 years back purchased shares of, let us say, Tata Corp, which is Indian company. But how did you purchase the shares? Let us say the value of those shares at that time was, instead of paying in dollars. Now, what is happening today? Today, after 10 years, when you are selling these shares, pay attention, today these shares are being sold for 25 lakh rupees. Let us say expenses on transfer is 5,000. So net consideration is 2495. And you had purchased this for 10x. Now, if this special provision would not have been in place, right, what we are discussing now, if this would not have been in place, then you would be doing the computation like this. How? Full value of consideration minus expenses minus cost. Now, all this you would have done in rupees. So, in fact, all our workings we are going to do in rupee only. However, what is the special provision? That since you had purchased this asset using foreign currency, we will do the computation by converting this into foreign currency. So what you have to do is, you have to convert all these values into foreign currency using the foreign currency rates. So let us say this divided, and let us assume just for simplicity that today's dollar exchange rate is rupees 100, just for example. So if the dollar exchange rate is 100, so this gets converted into dollar. This gets converted into dollar. So you get the dollar value. Now this is also converted into dollar, but at that year's rate. Which year's rate? The year of purchase. Let us just assume that year the rate of dollar was 50 rupees. Right? Today it is 100. And that year the rate of dollar was $1.50. So when you are dividing this, it will get converted. So you are getting the capital gain like this. Now this capital gain has come in dollars, right? Now what the computation says, reconvert this into rupee, taking today's exchange rate. What is today's exchange rate? 100 rupees. So your answer will be, now by this mechanism, the answer would have come different. It would have taken directly the difference in the rupee value. But you are going to do it first by converting all the values into foreign currency. And then whatever is the gain you are getting in foreign currency, reconverting it into Indian currency. So your final answer is like this. This is what is the special provision given. But I will suggest that you need not pay much attention to this. For the time being, you can ignore this provision because we have lot many other provisions which are relevant, which we will focus on. So what does this special scenario of computation says? The cost of acquisition, expenses, everything, right, which are incurred have to be converted into the same foreign currency with which you had purchased these shares, right? How these conversions will be done? The conversions will be done in foreign currency by taking the average foreign exchange rate, right? And then whatever is your final capital gain, that capital gain will be reconverted into Indian currency using the same transfer or exchange rate. This is how the computation has to be done. So this is the special mechanism given for non-residents, correct? I'm just 3 point, page 3.404. Why I'm mentioning this? So that in future, if we are referring back to this, it will be easy to locate this from our model. Okay. Now, after going through these specific points, let me take you to something important. Now, from here, students will have to keep things in mind, at least not thoroughly, but at least start keeping these things in mind. Now, today we are only in the computation section. In computation section, you require four values. Sale value, which is called as full value, expenses on transfer, cost of acquisition, cost of improvement. Today, we are going to study everything revolving around this. Now we start with understanding what is cost of acquisition, again in some special circumstances, right? Okay, let me just, yes, beta Kuldeep, all these, if you are given any of these special cases, like where indexation is required in that option, or where this conversion rates are required, everything will be given in the exam, Kuldeep. Don't worry. Just a minute, students. Okay. Now, in the computation, we are discussing about cost of acquisition. And this is in a very special case, which we will call as section 49.1. For entire 49 we are discussing. Right now we are discussing 49.1. Now, as you can see, 49.1 has so many items. That is why it is so important. So we are discussing cost of acquisition, and cost of acquisition we are discussing under section 49. But this 49.1 you will get in many questions. That is why this is very, very important. Now, what is this 49.1 dealing with? Let me show you. Now, do you remember we had been studying this chapter using some golden rules which I have created, right? Now, in this golden rule, first golden rule is this entire head is exceptional, which means in every provision that you study, you will get exceptions, so that you are observing. Now, second golden rule is very important. Now, what was the second golden rule, students? I had explained this saying that if the capital asset which you are having today was acquired by you in one of the methods which is not regarded as transfer, then there are two important points that you have to keep in mind. So let us say today the building in which you are staying was gifted to you by your mother. So let us say 10 years back, your mother gifted you this building, and this building you are going to sell in the current year. Now, when you are selling this building in the current year, this golden rule 2 will be applicable to you. Firstly, for what? Firstly, for deciding the period of holding. Now, what is my golden rule 2 saying? That if this capital asset was acquired by you in any one of the modes, any one of the methods which is not regarded as transfer, example gift, example will. There are so many cases. If you remember, we had studied the whole list of what is not transfer. Then the first point in this golden rule 2 is your period of holding will not start from the year in which you got the asset. Now, our general rule is period of holding starts from the date when you acquire the asset, right? However, in such cases, the period of holding will start from the date of your previous owner. So you got the gift 10 years back. So let us say in the year in the year 1516, your mother had gifted you this building. Or let us say by way of will you got this building in 1516. Now, general rule is your period of holding should be 10 years because you are holding this building from 1516. However, what is the special point? We studied this earlier in the period of holding point. It says that your period will be counted not from your date, but from the date when your mother had purchased it, because mother is your previous owner. Let us say when she had purchased it in the year 2008-9. So first we studied this golden rule with respect to period of holding. Today we are studying this golden rule again with respect to cost of acquisition. Now, same rule. If the capital asset was acquired by you in one of the methods or modes which is not treated as transfer like gift, will, etc., what will be your cost of acquisition? It says it will be cost of acquisition of so today when you have to compute the capital gain of this building which you are selling today, what will be your cost? You will ask your mama, mama, at what price you had purchased this building, and whatever is her cost, that will be treated as your cost of acquisition. So, what is this golden rule? Whenever the asset was acquired by you by way of gift, will, inheritance, or any of those methods which we studied in the not transfer list in our very first class, then in all those cases, what will be taken as your cost? It is the cost of your previous owner. Now, this golden rule you will find here in many provisions. Firstly, 49.1, what it covers? Capital asset became your property. How? In all those modes which are not regarded as transfer. First, what was not transfer, students, if you remember? Partition of HUF was not transfer. Getting asset by way of gift will is not transfer. Getting assets by way of succession inheritance is not transfer. Then where company is under liquidation and it is giving the assets to its shareholder, that is not transfer. Students, I hope you all remember all this. This all was list of not transfer. There, where the asset is given to a trust by way of donation, that is not transfer. Then holding, selling the assets to its subsidiary, or subsidiary selling the assets to its holding, where it is 100% holding subsidiary. Then, in case of amalgamation, in case of demerger, it was not regarded as transfer. In all these cases, it was not to be treated as transfer. Students, I hope you all remember this. Right? Yes, reverse mortgage, yeah, correct. So that all was the list of not transfer. Now, in all these cases, what is the rule? What is your cost? The previous owner. Your cost is cost of previous owner. Correct? I'll come to your point, Neeraj. Shouldn't just give me 2 minutes. Okay. Now, I will be also parallelly writing this down here. So see, we are understanding the provisions. Now, this provision was about the charging section. Now, right now, we are discussing the provisions about cost of acquisition, right? So you have again, students, generally what is cost of acquisition? That you study in section 55.2. What is the general rule? What is cost of acquisition? Cost of acquisition will be the cost at which capital asset is purchased or constructed by the assessee plus all expenses incurred up to the asset becomes ready for use. So this you will sound familiar to you. This is all what you studied even in accounts. This is all what you follow as a general understanding of cost. So it is the cost at which you purchase or construct an asset, plus it includes all expenses till the asset is ready, right? But this is the general rule. Right now, we are studying the special rules or rules applicable in some specific cases. Now, what is this? This is the special rule. So let me call them as exceptions. So what are the exceptions? So for this, the exception is, now in this right now you have section 49(1). What it says? Your cost is cost of previous owner. And this is also part of our golden rule that whenever the asset was acquired by you, in those cases, which is in the list of not transfer, that is what is covered in 49(1). 49(1) says in all those cases, you will take the cost as the cost of your previous owner. Now, this is the first exception where it says cost is cost of previous owner. Fine. Now, when we go further, students, you will find my golden rule being followed in many provisions. Again, 49(2), it deals with what? At the time of amalgamation, the shareholder received shares. How the shareholder received shares? If you remember, we had discussed this. You gave away your old shares, you received the new share, right? Again, if you remember, this was not transfer. So 49(2) deals with what? 49(2) deals with the case of amalgamation, where the shareholder gave away the shares of old company, and in exchange, he received the shares of new company. Now, what is the point discussed here in 49(2)? 49(2) deals with cost of acquisition of this new company share. What it will be? It will be cost of acquisition of old company share. Why? Same, our golden rule. See, all these are falling in our golden rule. So even though you are studying sections here, but it is all covered in my previous owner rule. So wherever asset was acquired by you in one of the modes which is not regarded as transfer, what will be your cost of acquisition? It is cost of acquisition of previous owner or the previous asset. Correct? So this is our golden rule. Why it is golden rule? You will find that many sections will be falling in this rule. So 49(1) covers many cases where you will take cost of previous owner as your cost. 49(2), which deals with amalgamation, where it shares shareholder gave away shares of old company, in exchange receive shares of new company. What will be the cost of acquisition of new company share? It is the cost of acquisition of old company share. Same 49(2)(a). What it deals with? It deals with another case of what is not transfer. What was that? You had purchased bonds, debentures, etc. And you returned back these bonds, and in exchange, you got shares or debentures. So we normally call it as conversion of bonds to debentures or shares, or debentures to shares. So in accounts, you have studied this convertible bonds, convertible debentures. Again, this was not regarded as transfer. Now the question is, now you have this new asset. What is the cost of acquisition of new asset? Answer is, it is the price at which you had purchased the old asset. So what it says, that part of the cost of debentures, debenture stock or deposit certificate in relation to which such assets is acquired. So what is the price of this new asset acquired? It is the price of the old asset. Again, our golden rule. Again, this 49(2)(a) deals with similar scenarios. I'll continue the exceptions here also. So 49(2)(a). It deals with what? Conversion of bonds or debentures to shares, debentures, etc. Again, what is the cost of acquisition of the new asset? It is the cost at which you had purchased the old asset. Again, fitting in our golden rule. Why? Because these are all cases of not transfer. In all these cases of not transfer, your cost will be cost of previous owner or the previous asset. Right, students? Now, I'll first explain you those provisions where the golden rule applies. That is all those cases of not transfer asset. And then I will take the different ones. Again, what is this case? Equity shares. How? On conversion of preference shares. Again, you remember conversion of preference to equity was not transfer. See, they have given you the sections also. These are all sections of not transfer. See, these are all sections of not transfer. All were under 47. So now what is the scenario? It is conversion of preference shares to equity shares. Again, what is the cost of this new equity shares? It is the cost of the old preference shares. So here itself, I will cover the same point because this covers. So preference shares are converted to equity shares, right? What is the section? Section 49 2E, right? Sorry, 2AE. Answer is same. What is the answer? Cost of acquisition of this new asset which you have received on conversion is what? Is cost of old asset. Now, similar to amalgamation, you have demerger. But in demerger, there is one different thing. Now, what we are talking about, you are a shareholder again. Again, you had shares in old company. Let us say the old company was company A. Now, what had happened in demerger? This company A got split. How? One part of this company A became company B, and the remaining part is company A only, but this is a smaller company. So let me call it as A dash. So after demerger, this one big company A became company B and a smaller company A. Now you have shares of the old company A. You return it, you get company B shares. Plus you also have the reduced company A share. So in case of demerger, against one share, you now have two shares. What are those two shares? Company B share and company A share again, which is a reduced company. Now the question is how to find out the cost of acquisition of both these shares. Let us say this share was purchased by you for ₹100. Now against one share of 100, now you have two shares. Now here the question is, the rule is same. Our golden rule applies here also, because what is the golden rule? Since this demerger is also not transferred, the cost of this new asset will be cost of previous asset. But now new, there are two assets, and old, there was only one asset. So what you will do, you will apply simple maths. How you will find out the shares of company B? So you will take the cost of old share and you will proportionate it. Proportionate it in what value or in what ratio? In the ratio of demerger. I will say, sir, what is this ratio of demerger? So the net worth of the old company was 1,000 crores. What it did, it gave 400 crores worth of net worth to this new company B, and the smaller company A is now having net worth of 600 crores. Now, to find out the value of company B shares, I will take the cost at which I purchased the original company A share, which is 100, and how much did company B receive in this demerger? 400 crores. Upon what is the total net worth before demerger? So I will get the value of company B share as 40 rupees. So this 100 is split into both. So I get rupees 40. On similar lines, I will find out the value of company A reduced share. How it will be? It will be rupees 100 minus rupees 40. 40 went to company B share. So what is left for company A share? The balance cost of 60. So see, the cost of acquisition of the original share, that is of company A, will be what? It will be after reducing the value that you arrived above. What value did we arrive above? We arrive above 40 rupees. So for company B, out of 140 is allocated. So what is left for the reduced company A share? The reduced company A will be total cost minus whatever you calculated above balance. So in simple, students, if you have to understand, it is simply we appropriated or apportioned the value of original company A share in the ratio of demerger. That is how the cost of old share became the cost of new share by proportionating the cost. Is this clear? And all these section students are resulting in that one golden rule. What? In case of no transfers, if you have acquired the assets, the cost of the new asset is either cost of previous owner or it is cost of previous assets. Perfect. So for demerger, they have given two different sections, 2C, 2D, but ultimately the effect is same, only you have to now proportionate the cost. Since now after demerger, you'll have two different company shares, so you will be proportionating it, right? Again, 49.4 is slightly different. I'll explain it separately. Yes. Again, see, not transfer. What is this? If you remember, government has a scheme whereby if you have physical gold, you can convert the gold to the electronic gold receipt. And even vice versa, you can convert the electronic gold receipt and get back the gold. Now, whenever you are converting gold to receipt or receipt to gold, both these are not treated as transfer. Now, the question is, what will be the cost of the new asset? So, if you gave gold and received gold receipt, which is not transfer, what will be the cost of gold receipt? It will be the cost at which gold was acquired. If vice versa has happened, you have given gold receipt and got gold, what will be the cost of gold? It will be the cost of previous asset, which is the electronic gold receipt. So again, I cover here 4910 also, because all these are cases of conversion. So in all these three cases, you got a new asset after conversion. What is the cost of this new asset? It is the cost of the old asset. Correct? And here we have 49.2C and 49.2D, which is applicable for demerger cases. Right? Students, if you read the sections there without this type of linkage, you may find it very technical. But once you are understanding the linkage, that is the golden rule which I have given, that you have to take the previous owner or previous assets cost, understanding the provisions becomes easier, right? Now, all this is one set of exceptions. One set means all these are following the same logics. What is the logic? Cost of the new asset is cost of previous asset or previous owner's cost. But besides this, you have some more exceptional cases. You have some more special cases. Now let us understand those exceptional and special cases also. I'm just changing the color of the pen so that it will be easy for you to understand. Now more exceptions to this. There is some more special cases. So this is all exception to the general rule. Now general rule is what should be cost? Cost should be the price at which you have purchased. You have constructed, including all the expenses on purchase. However, exception is you take some other value. Now, what is this other category of exceptions? Let us see. Now, for the cases where no transfer was not existing. Now, what are you transferring? You are transferring those securities which you had received as sweat equity shares. Now, when you have received any asset as sweat equity shares, what will be your cost? The cost is fair market value. Now, here again, I'll give you one more golden rule. Now, pay attention to this, students. Now, this golden rule is going to be interesting. What is this third golden rule? Third golden rule is where at the time of acquiring or receiving the capital asset, it was taxed as income under some head. Now, what is this third golden rule? It applies to the case where when you were receiving the capital asset. Now, see, when you are receiving something, that is when you are purchasing or acquiring a capital asset, there should be no tax. Tax arises only when you transfer. But there are some specific scenarios where at the time of acquiring, at the time of purchasing the asset, there is tax. So if at the time of acquiring or receiving the capital asset, it is taxed as income under some head, then what is the cost of acquisition of such assets? It is the value considered for computing income under that other head. So when you were receiving the asset, at that time itself, it was taxed under some other head, maybe salary, maybe PGBP, maybe other sources. So for such asset, which at the time of acquiring or receiving, you had already paid tax. So for such asset, what will be your cost? It will be that value which was considered for computing income. Now you'll say, sir, what are these cases? So that is what is our second bunch of exceptions. So second bunch of exceptions covers the first case of security acquired as ESOP. So what is ESOP? You are employee of a company. The company gives you its own shares, debentures at a very low price, or it gives you free. So when a company gives its employee its assets free or at low price, it is called as ESOP. Now, whenever you receive ESOP, salary head has taxed it. You would have studied this under salary head. And under salary head, what amount got taxed? So when you acquired this, when you received these as ESOPs, the salary head taxed it at FMV. So what is your cost of acquisition? The cost of acquisition is the amount which got taxed under the salary head. So for the purpose of computing salary income, salary head said that whenever you receive a capital asset as ESOP, we will tax it under the salary head, and for that purpose, we will take the FMV. So under this category of exception, the first scenario is where the asset was received as ESOP, it was taxed under the head salary. And what value was considered over there for taxing? FMV of that share. That FMV is to be taken as your cost of acquisition. This is our golden rule 3. Right? See, it was taxed under 17 to 17 is for salary head. Now, similarly, another case. What is this? Now, this you will study under the head other sources, where we say that gift is taxed. So when you are receiving any asset as gift, you will have to check section 56 to 10. As per 56 to 10, some specific gifts will be taxed, not all. There are some conditions given. Again, there are some exceptions given under that head. If you satisfy those conditions and you are not fitting in exceptions, then whatever is received by you as gift is taxed under the head other sources. Now, let us say somebody has gifted you jewelry, somebody has gifted you building, somebody has gifted you shares. Now, all these things, when you are receiving, and if you see, all these are examples of capital asset. So when you are receiving these capital assets, jewelry, building, shares, they were received by you as gift and it got taxed under other sources. Now, when gifts are getting taxed under other sources, this is the section 56 to 10. Now, what does our golden rule 3 says? That at the time of receiving, at the time of acquiring the asset, if it is getting taxed under any other head, then whatever is the value taken over there for taxing that gift, for taxing that asset, will now become the cost of acquisition for us. So the same amount point is given. The value which is taken there in that head under this section will now become our cost of acquisition. So what is the second point here? Asset received as gift taxed under section 56 to 10. This is the section of other sources head. Again, what will be our cost here? It will be value which is considered in 56 to 10. So whatever value they are taking, now why we are writing value, why we are not writing anything? Because when you study 56 to 10, you will get that two values are taken. For movable properties, they are taking FMV as a value, and for immovable properties, they are taking stamp duty value. So there are two values that they take: stamp duty value for immovable properties, and for movable properties, they take FMV. So whatever is the value taken over there, in other sources or taxing it will become cost of acquisition over here. Correct? I'll write one thing. Golden rule 3. Let me put it like this so that it is easy for you to differentiate. This is golden rule 3. Correct? Okay. Remaining are all golden rule number 2. Next, where capital gain arises from transfer of a capital asset which was used by the assessee as inventory earlier before its conversion. Now, what is this case? You had SIT, that is stock in trade. You converted it into capital asset. Now, again, same thing. When you converted SIT into capital asset, this was taxed under section 28, that is PGBP. So, same golden rule 3 applies. What was taxed in PGBP when you converted the stock in trade into capital asset? The fair market value. Now, since this fair market value was taxed when you converted the stock in trade to capital asset, so what will be the cost of this capital asset? It is the same value which got taxed, which is the fair market value. So again, this is golden rule 3. What is our third case in this? Again, fitting in our golden rule 3. SIT converted to capital asset, taxed under section 28. What is the value which is taxed over there? FMV on date of conversion. So the same FMV which was taxed under PGBP will now be treated as cost of acquisition of this asset under capital gains. Done. So these are some special cases given in 49. But if you see, all these special cases are basically fitting in only 2 logics, which I have given the name as golden rules. Golden rule 2, your cost is cost of previous owner or previous asset when this rule will apply if at the time of acquiring the asset it was not transferred. Second, golden rule 3, when this logic will apply when at the time of acquiring the asset it was already taxed under some other head. In such cases, the cost of acquisition will be the value which was considered under that head for taxing it. These are the 2 logics in which all these special cases of section 49 are falling. Now you come to the general rule, which I already explained. What is the general rule for cost of acquisition? 55(2) says, the general rule for cost of acquisition is the amount, the price that you have paid for the purpose of purchase or acquisition of the asset, plus the expenses that you have incurred. So this I had already explained. What is the general rule for cost of acquisition? The general rule is the cost that you have paid for purchasing plus the expenses that you incur so that the asset becomes ready, the asset becomes fit for use. Now, what does further 55(2) says? So firstly, it is giving you the general rule. What is general rule? The cost is same as per accounts and accounting standards. It is the price at which you have acquired the asset. Now, in this case, we are again going to study cost of acquisition relating to some specific assets. What are these assets? First is intangibles. So now, like goodwill, trademark, brand name, what will be the cost of all these intangible assets? The answer is very simple. You have to see if these assets were purchased by you or these assets were self-generated by you. I'm sure you all understand the meaning of this because, again, as a student of accountancy, you know what is the meaning of self-generation. So in case of intangibles, we always have this question whether the intangibles are purchased or they are self-generated. Now, what is the answer? The answer is simple. What are we dealing with? We're dealing with special cases of cost of acquisition. So we are still on the cost of acquisition part. In cost of acquisition, the next category is cost of acquisition of intangible assets. What are these intangible assets? Goodwill, trademark, copyright, etc. Now, for this, what is the rule? There are two possibilities given. Whether these assets are self-generated or it is purchased. If these are self-generated, the law says cost of acquisition is nil. If these are purchased, the cost of acquisition is your actual cost of acquisition. So for intangible assets, again, there is a special rule. You can call it as exception or special, that if these are self-generated, now in accounts, you know what is self-generation. So you have not purchased. You are simply passing a journal entry and creating goodwill in your books. So when you are self-generating these assets, since you have not paid any price, it will be taken as nil. Kuldeep, I did not get your question, beta. You're talking about what? So in case of goodwill, which is many times only generated in the books, what does the law says? The cost will be taken as nil. However, if you have purchased the goodwill, the trademark, the copyright from someone, obviously you have paid some price, then whatever is the price paid, that will be taken as your cost of acquisition. So in case of intangibles, this is what is the rule given. Correct? Then comes the next category, that is some financial assets. Now, financial assets means shares, securities, etc. Now in this, what is given? So in this, again, there are some interesting rules given. Now, what are financial assets? These are shares, bonds, debentures, etc. Now, in this, you have some special cases of right shares. Now, before you purchase the right shares, you are given the rights, correct? And then you have bonus shares. Now, what is the rule? Rights nil, bonus shares nil, right shares the actual cost of purchase. So you would have paid some amount for purchasing the right shares. That is your cost of acquisition. So for right shares, the cost of acquisition is the price paid. But before purchasing the right shares, you first get the rights. Now for rights, it is nil. Similarly, for bonus shares, which you get free, the cost is nil. So for financial assets, these are some special cases of cost of acquisition. Correct? Okay, students, we'll take a break here. So we have completed up to this part, up to here, right? Let me first take your questions, if any, up to this part, and then we'll go in for a break. If amount paid is less than the price will be incurred, I'm feeling line below 0.4.12 in material. 4.12. Which page beta 4.12 you are seeing? Which page 4.12? 3.408. 3.408. Okay. So what you are saying, beta? Here what you are saying in page 4.12. Kuldeep, would you like to unmute and say beta, because I'm not able to understand your half of pointers. Would you like to unmute, please? Kuldeep.
Hello.
Yes, Kuldeep.
So here mentioned is cost of acquisition is the price that SSE has paid,
Mm-hmm.
comma, or the amount the SSE has incurred for
Hmm.
acquisition of the assets. So if paid amount is less than the incurred, okay, means
What
full
is the difference beta paid and incurred? What is the difference?
paid means actual payment and
Hmm.
incurred means original value means which has to be paid. If such scenario can happen or not.
Yeah, again, Kuldeep, please
I, if I
understand.
if I acquire asset 1 lakh and I have paid only 80,000.
And 20,000 are you showing as liabilities?
Yes, yes, yes.
Then it means it is 1 lakh only, beta. 20,000 you'll pay in future.
Hmm. So
See, we are
incurred is
not
the
following cash basis. We are following the basis where if you have agreed that the price is 1 lakh, but today, right now, you paid 80,000 and you'll pay 20,000 after some date, the price will be taken as 1 lakh.
okay. So it is some slightly confusing. That is why asking because paid is something different than incurred.
Correct. So I've clarified beta, right?
Clear, clear. Thank you.
Okay. So students will go in for break. We'll take a 15 minutes break. And when we come back, we take more scenarios of cost of acquisition. And then we proceed further to the other provisions. Sorry. So now we are trying to understand cost of acquisition in different scenarios. First, in all these cases, we studied cost of acquisition is cost of previous owner or previous asset. Then in case of goodwill, it will be nil if it is self-generated, and if it is purchased, it will be actual cost. In case of financial assets, original shares, it will be the cost of purchase only. Right entitlement, it will be nil. Right shares, it will be cost of purchase. Bonus shares, it will be nil. Yes, I can see there is something special, but this I'll explain when that particular point comes. This is a very important provision. Once that comes, I'll come back to this point to explain. But for the time being, the cost of bonus shares is nil. Then right shares which are purchased by a person in whose favor the assessee had renounced its rights. In such cases, again, the actual cost at which you acquired the right shares, including the cost of rights, that will be the case. Now, this is again a very special scenario, students, which I'll discuss separately. So I'm leaving these 2 points because they have a linkage with something which we are going to study further. Now coming to a very, very interesting provision. What is this provision? The provision says that if the capital asset was acquired by you before 1st April 2001, so it is now around 25 years plus, we are talking about this date. So if your asset is more than 25 years old, in simple words, right? That is, it is purchased before 1st April 2001. What does this special provision says? So, asset acquired before 1st April 2001. Now, in this, there are two categories: A, land or building; B, other assets. Sorry. Now, what does the provision says? If your asset is acquired before 1st April 2001, your cost of acquisition will be higher of actual cost of acquisition or FMV on 1st April 2001. So if the asset is of a date before 1st April 2001, assessee so if the asset is an asset acquired before 1st April 2001, the law gives you an option to take the cost as your actual cost or the FMV on 1st April 2001. Obviously, as an assessee, what you will prefer? You will prefer the higher. So law has given you option, but I have written here higher because logically as an assessee, you will take higher of this. Now, when it comes to land building, What is the provision? The provision is same. It says that what will be your cost of acquisition? It will again be hmm, 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 higher of actual cost or FMV on 1st April 2001. But this FMV has to be compared with stamp duty value on 1st April 2001. And importantly, this FMV cannot exceed the stamp duty value on 2001. So for land and building, provision is same with one change that whatever FMV on 1st April 2001 you are going to take, first compare it with the stamp duty value on the same date and ensure that the stamp duty value is higher than FMV. Then only you can take FMV. If stamp duty value is lower than FMV, then you will have to take the stamp duty value and compare it with your actual cost. So, in case of land and building, the provision is FMV on 1st April should not exceed the stamp duty value on 1st April. If FMV is higher, then you will take the stamp duty value and compare it with actual cost of acquisition, and whichever is higher is your cost of acquisition. Now, this is a very special rule and it applies to all assets acquired before 1st April 2001. And that is what is the importance of this provision. So, that is what is given over here. Key cost of acquisition will be your actual cost or the FMV, and the provision says at the option. But obviously, since it is cost, you would like to take the higher amount so that the capital gain is less. However, if the asset is land or building, then you have to ensure that the fair market value should not exceed the stamp duty value. If it exceeds, then you have to take the stamp duty value. Now, in this same point, what if your case is falling under 49.1? What is 49.1? You have to take cost of acquisition of previous owner. And the previous owner had purchased the asset before 1st April 2001. What does the provision says? The provision says simple. Apply the same rule to previous owner. So let us say in that example, your mother gifted you the building in 2010-11. Fine. Now your rule is you have to take the cost of acquisition of your mummy. However, when you check the cost of acquisition, you find that mummy had purchased this in 1996-97. Now 49.1 says you have to take cost of acquisition of previous owner. But the previous owner says cost is before 2001. Then what does the provision says? Simply first find out previous owner's cost by applying this rule. So your mummy's cost of acquisition of that building will be her actual cost of 96-97 compared with 1st April 2001's value. Which value? Now, since this is building, you will take fair market value, compare it with stamp duty value. If stamp duty value is higher, fine, take the fair market value. If stamp duty value is lower, take the stamp duty value. In short, FMV or stamp duty value, whichever is lower, you take that value, compare it with the actual cost at which mummy had purchased in 96-97, whichever is higher, that will be your final cost of acquisition. This is how now we are merging two provisions, this 1st April 2001 rule with the previous owner rule. So by merging both these, your answer will be you have to take cost of previous owner as per 49.1, but previous owner's cost will be determined by this particular provision. Fine, students. Is this clear to all? So this is what is the provision of 2001. Correct? Any doubts or questions? Now, what is the next scenario? Where capital asset became property of the assessee on distribution of capital asset of a company in its liquidation, and the assessee has been assessed to capital gains in respect of that asset under 46. The cost of acquisition means the fair market value. Now, again, this is our golden rule 3. So, what is this golden rule 3? Asset acquired from company under liquidation. What is your cost? FMV on date of distribution. Again, this is falling in golden rule 3. Why? We will study this in section 46 bracket 2 that when a shareholder at the time of liquidation gives away his shares and gets some assets in the hands of shareholder, whatever asset is received, the FMV of that asset is taken for determining the capital gain on the shares. So at the time of receiving, the asset became taxable in the hands of the shareholder. Hence, this rule has come up. Correct? Okay. Now, in all these cases we studied where the share or stock of a company becomes your property. How? At the time of consolidation, conversion of shares, reconversion of shares, subdivision. In all such cases, your cost is cost of previous asset, where the cost for which the previous owner acquired the property cannot be ascertained. Now, in some cases, we have to take cost of previous owner. We studied this at the start. But what if previous owner's cost is not ascertainable? Now, in such cases, where 49(1) asks you to take cost of previous owner, but previous owner's cost itself is not ascertainable, then in such cases, the law says, no problem. If the previous owner's cost is not ascertainable, you can take the FMV on the date on which the previous owner gave the property to you. Sorry, the FMV on the date on which the asset was acquired by the previous owner. So I come back to this point. So here, in all these cases, you have to take cost of acquisition of previous owner. This is as per our golden rule 2. Right? Now, in all these cases, where the law asks you to take cost of acquisition of previous owner, but if previous owner's cost is not ascertainable, then the law says you can take on date of acquisition by previous owner. But when this rule will apply, if this cost of acquisition is not so 49(1) says take cost of acquisition as cost of previous owner. But then this provision says if this cost of previous owner is not ascertainable for any reason, Then what you will do? You have to still tax it. So how you will tax it? By taking the FMV of the asset on the date on which the previous owner had acquired it. So cost of acquisition at a glance. So whatever we studied about, they have summarized it in the form of table. So for intangible assets like goodwill, etc., self-generated nil, acquired, then actual purchase price. Now in this, there is one small carve out. If you had already taken some depreciation on this particular cost of goodwill earlier, then purchase price minus the depreciation. So that will be the WDV, where the asset became the property of the assessee by way of distribution by HUF at the time of partition. It is again the cost of previous owner. Capital asset being goodwill or business or profession which was acquired by previous owner by purchase and in respect of which depreciation has been claimed, purchase price reduced by depreciation. Now, bonus shares. This was the point I had left earlier. Now, if you remember what rule I had given you, bonus shares, what is the cost? Nil. But now we have studied this 1st April 2001 rule. Now apply it collectively. If bonus shares are allotted to you after 1st April 2001, the rule is nil. But what if they are allotted before 1st April 2001? Now we just studied the 2001 rule. What it said, the cost will be higher of actual cost or FMV on 2001. Now, since the actual cost of bonus share is nil, if it is acquired before 2001, by default, the answer will be FMV on 2001. So I hope you understood this point. So this point is applicable to bonus shares. Why? Because of the application of the rule of 2001 value. So where 2001 value is to be taken, then in such cases, it will be FMV of 1st April 2001. So if bonus shares are allotted afterwards, it will be nil. If it is allotted before, then applying 2001 rule, it will be FMV of the bonus shares on 1st April 2001. This part I have still kept aside because this is a very specific case. So now only one part I have kept aside that we'll discuss separately. Then again about right shares. First, the original shares, it is the purchase price. Then the rights which you receive, it is nil. The right shares, it is the actual amount. Right? Right shares purchased by a third person. In such cases, it will be again the price paid, firstly for the rights as well as for the right shares. So this is that special point which I am keeping aside. This we are going to study specifically, separately. So just remember this date. We are just keeping this one point aside. See this, or wherever this date has come, I have kept that point aside. Here also I have marked it that we are keeping this point aside. See. So where shares are acquired before 1st February 2018, I've just kept that point aside. I'm not explaining it right now because it will be too technical. So see, wherever this 1st February date point has come, I have kept that point aside. So we are going to study it separately. Then this 1st April 2001 rule, if asset is acquired before 1st April 2001, the law says we are giving you a choice. What is the choice? Take your actual cost or FMV. Obviously, we'll take whichever is higher. And in case of land building, you have to first compare FMV with stamp duty value. First take out of these two whichever is lower. Compare it with actual cost of acquisition and then out of both whichever is higher is your answer. If the same situation arises, but in case of 49.1, that is you have acquired the asset in one of the modes which is not transfer. So 49.1 says take cost of previous assessee, that is your previous owner. But previous owner has acquired before 1st April 2001. Then cost of previous owner compared with FMV of 2001, whichever is higher. So you first find out previous owner's cost taking the 2001 rule, and that cost will be taken as your cost. And then when the cost of previous owner is not ascertainable, then what you will do? You will take the FMV. So these are the cases of cost of acquisition. Now we come to cost of improvement. So we discuss all these provisions only related to one point, that is cost of acquisition. Just write it down in bold. General rule is in 55.2. Now we come to cost of what is cost of improvement? Again, general rule, which is given in section 55.1b. What is the rule? What is cost of improvement, students? In very simple words, it is the capital expenditure incurred after acquisition. See, I'm purposefully using the language that you know from accounts so that it is easy for you to understand and remember. So what is cost of improvement, students? You purchase some asset, you incurred expenses on its purchase, all that was cost of acquisition. Now, after few years of purchase, you do some capital addition, which we call as capital expenditure, which leads to increase in the life of the asset, value of the asset, usability of the asset, which in accounts we consider as capital expenditure and we capitalize it. So when you are incurring any capital expenditure after the asset was acquired, such capital expenditure is called as cost of improvement. So see what is given. 55.1b says that cost of improvement is any type of capital expenditure which is incurred after its acquisition. However, again, there are some exceptions. There are some special cases. So, exceptions. Exception, firstly, intangible assets. What are intangible assets? Goodwill, copyright, trademark, etc. Cost of improvement is nil. So for all intangible assets, they say cost of improvement will be taken as zero. Correct? Dhanalakshmi, no. For land and building, you will take the 1st April stamp duty value and 1st April's FMV. Compare both, take whichever is lower. Out of stamp duty value and FMV, whichever is lower, that value is compared with your actual cost, and then whichever is higher is taken. So for land and building, 1st April's FMV compared with 1st April stamp duty value, whichever is lower. Because see, what does the language says? FMV cannot exceed stamp duty value. It means you have to take the lower value. So FMV stamp duty, whichever is lower. Now this amount, compare it with your actual cost. Out of both these amount, whichever is higher. That is what is your answer, Dhanalakshmi. Perfect. Coming back to cost of improvement. So general rule, it is the capital expenditure incurred after acquisition. Now exceptions. First, in case of intangible assets, law says cost of improvement is nil. Then for other assets, now what are these other cases where the case is covered under 49.1? What is 49.1? 49.1 is where you have to take cost of previous owner. Now interestingly, same example, your mother gifted you the building in 2010-11. Now the law says you will take cost of acquisition of your mother. Fine. What if mother has also incurred cost of improvement? Now if mother has incurred cost of improvement, what you will do? So remember one thing. First rule for intangibles, cost of improvement is nil. For all other assets other than intangibles, the rule is cost of improvement before 1st April 2001 is to be ignored. Ignored means you will take it nil. So where you have incurred any cost of improvement before 1st April 2001, or in case of previous owner, your previous owner has incurred any cost of improvement before 2001, the rule is all cost of improvements done before 2001 has to be ignored, means taken as nil in your computation. So in simple words, for cost of improvement, 2 points have to be kept in mind. One, for intangibles, it has to be taken as nil, and cost of improvement done before 2001, it also has to be taken as nil. Correct? So this is all given here. Now, here we complete cost of improvement. Now we come to some very special cases of computation. So we completed cost of acquisition, we completed cost of improvement, right? Now we come to special cases of capital. Now, in this, our first scenario is now pay attention, students. What is special about depreciable assets? Now, we all have studied the topic of PGBP. In PGBP, we have seen that for depreciation, you have the block of asset method. Now, what was the block of asset method? I'll just repeat over here. So you have opening WDV of the block on 1st April. So in our case, it will be 25. In that you add additions. What is the additions? Purchases during the year. This is a total. From that, you subtract sale value of assets sold, and then you get a WDV, which is called as WDV under section 43.6. I hope students you recall this. We studied this in PGBP. Now let us say you're talking about a block of asset of plant and machinery where you had 5 assets. So this block, let us say, is of plant and machinery, and there are 5 machines in this block. So the value is 200 crores of this 5 machines. You purchase 2 more machines for 100. So total becomes 300, and now the machines are 7. Right? Now you sell out of this old, you sell 3 machines. Now let us say these 3 machines gives you 350 rupees. Or firstly, let me just say it gives you 50 rupees. Now what we studied that you first find out the WDV of your block. Now in this first example, the WDV is 250 and there are 4 machines. So here we do not compute any capital gain or loss. So even though you have sold 3 assets, you will not compute capital gain or loss. This is what is a special block method, if you remember. We continue to compute depreciation, right? However, in this same example, I rewrite this here. If let us say I had sold these 3 machines for 350 rupees. Now what has happened? If I've sold the 3 machines for 350 rupees, my total cost of the block was 300, but I received 350. It means the WDV of the block has become 0. I have assets, but there is no WDV. Third scenario. Let us say I have sold all 7 assets for 280. Now, even though there is some WDV, but there are no assets. Now, in this scenario, the law says calculate depreciation under section 32. But for these two scenarios, scenario 1, scenario 2, the law says you will be computing capital gains. Why? Because either the WDV has become zero or the assets have become zero. So what are these two cases? First case is WDV of the block becomes nil. What is the second scenario? Second scenario is called as block becomes empty. Please understand, students, simple accounting logic. You can claim depreciation only when both the things exist. One WDV and the other is asset. If any one of the thing has become zero, the WDV has become zero or the block has become empty. In both these cases, you compute capital gains. And this is what is the exact point we are going to discuss now. So now we are in the special cases, some special scenarios. And the first special scenario is for depreciable assets, which is part of your block of assets concept of PGBP. What it says, section 50, transfer of depreciable assets. What it says, that wherever you are having capital asset, which is a depreciable asset, and this depreciable asset is part of block of assets, then section 50 has overriding effect on 242A. 242A defines short-term asset. It overrides 242A. Now what it says, where capital asset is asset forming part of block, then you have been calculating depreciation. But now what it says, pay attention to the language, where the full value of consideration received or accruing for transfer of the asset plus the full value of consideration for transfer of any other capital asset falling within the block, etc., exceeds the total of what? Expenses, WDV, actual cost. Then such as excess shall be treated as capital gains. And interestingly, it shall be treated as short-term capital gains. So what is interesting to note is that the special method given in section 50 is that where this sale value, now what exactly they are talking about? They are talking about the first case, this, where this sale value exceeds your cost of the block, then the excess is capital gains. This is the important point. Further, what it says, where all assets in the block are sold. Again, it means that the block itself is not in existence. Again, in such case, they say there will be capital gain or loss arising. So two scenarios they have given. First scenario, where your sale value exceeds the WDV, which I'm calling here as WDV of the block becomes nil. Second scenario I'm calling as block becomes empty. That is where all assets in the block are sold. In both these cases, section 50 says you have to compute capital gain. And most important, this will always be treated as short-term capital gain. So this is also interesting. For block of assets, they are saying we will treat this always as short-term. Students, do you recall any such thing studied earlier where the law has said that we will assume that this is always going to be short term? Do you remember any such thing studied earlier on similar lines? Shamli says under PGBP. No, I'm talking about capital gains, beta. You remember? When we were studying the concept of long-term, short-term assets, at that time we had studied this, that in case of long-term, short-term also, every rule has exception. This rule also has exception. And in that exception, when you transfer some assets, they will always be treated as short-term capital gain. So the rule that gain arising from long-term asset is long-term, gain arising from short-term asset is short-term is having exception. So the first exception, yes, Dhanalakshmi, you rightly pointed out 50AA. Yes, correct. Disha, Atisha, specified unlisted bonds and debentures. Correct? No, Kuldeep, no. So if you remember, we had studied this point earlier under 50AA. And here also, if you see, the section applicable here is section 50. So you can say 50 is having that specific point. So chalo, I'll write it here for our future reference. So this rule of capital asset being long-term, short-term has exceptions. The exceptions is the only thing which is consistent in this chapter. And that is what is adding beauty according to me. Correct? Section 50, which is dealing with depreciable assets of block, and 50AA dealing with specified mutual funds, market linked debentures, and unlisted bonds debentures. There will be one more thing later, but for the time being, all these will always be treated as short-term capital gain. So the rule of long-term, short-term, 12 months, 24 months has two exceptions. One which we studied earlier only, the second which we are studying now. There is one more. Let's see. When it comes, we will add it here. Correct? Then, if you remember, in PGBP, we studied this also. If you are engaged in power generation, so you are a power sector, you are given a choice of claiming depreciation either by block method, that is this method, or by SLM method. If you are claiming the depreciation under block method, then whatever we studied above applies. But if you are claiming depreciation under the SLM method, straight line method, in that particular case, the block method is not applicable. And in that particular case, this section 50A says that in case of depreciable asset referred to in 3211, that is SLM, the provisions of 48 and 49 shall apply subject to modification that WDV of the asset as defined in 43.6 as adjusted shall be taken to be the cost of acquisition. So in short, in case of SLM asset, the cost of acquisition will be WDV of the asset. Correct? But that is subject to the adjustment. So here comes the point of 50AA, capital gain in case of market linked debentures. What it says, transfer of units of specified mutual funds, market linked debentures, and unlisted bonds and debentures. 50AA provides that the computation of capital gains in case of transfer or maturity of these things, specified mutual fund units, which are purchased after this date, market linked debentures, and most important, unlisted bonds or debentures. For them, again, this section is overriding the definition of short-term asset under 242A, where the 12 months and 24 months rule were given. And in this case, what it says, the capital gain arising from transfer of all these would be deemed to be short-term. How to do computation? The full value of consideration which you will receive on the redemption or transfer of the above assets, you will subtract the cost of acquisition and the expenses which you have incurred. So same format they are giving. So there is nothing special in the format. Only what they have clarified is that this will always be treated as short term. Most important point, since you're talking about securities, debentures, there is a possibility that if you are selling it on a recognized stock exchange, you are paying STT. But we have studied earlier also, there is no deduction for STT. What are market linked debentures? What are specified mutual funds? Definition of them is given. We need not learn them because that will be given in the exam. Now comes another special case. We'll do this and then we will close for the day so that we would have completed around 70% of our provisions in today's lecture. And in the next lecture, we can start with the computation. Now, this is again a very special case of computation. It is the case of slum sale. Now, first understand what do you mean by slum sale? So, slum sale is a scenario where a company, let us say it is company X. This is the balance sheet. Now, this company has two divisions, division A, division B. What is division A? It is a manufacturing division, and division B is the marketing division. Now, many times you'll find that FMCG companies have two parts, two verticals. Now, in the balance sheet, here you have share capital, reserves, and surplus. This is common. Long-term loans, etc., may be common. But then you have specific liabilities also for the division. So here you have specific assets, here you have specific liabilities. Now let us say this company wants to diversify. How? It wants to only focus on the manufacturing part. So what it wants to do, it wants to sell off the marketing part. So what it is doing, it is selling the marketing division. So it is selling off the marketing division, and most important, this is done for a lump sum price. So the entire marketing division is sold for 500 crores, a lump sum price. This is very important because when we talk about slum sale means you are selling off the company or its division, and most important, it is done at a lump sum price. That is, you have not found out the price of individual assets and liabilities. Now, I'm sure again in accounts you would have studied this, that when we sell this division to someone, I have some assets, I have some liabilities. So you are selling both the assets and the liabilities, both. Now, in this case, how to compute capital gains? So, in special cases, the second special case is small section 50 bracket 1 and 2. This is now slump sale section 50B. Now, what is the special point given? The special point given is that when you have sold this marketing division, there would be multiple assets, some buildings, some machines, some vehicles, etc. But you are not going to compute capital gain of each asset. You are going to compute capital gain for the undertaking or the division which is sold. In other words, for you, the capital asset is the undertaking or the division. Full value, in my example, 500 crores, which is the lump sum price, minus expenses on transfer. Here it will be legal costs, etc. Let us say it comes to 5 crores. So net consideration 495 crores. What is important is this cost of acquisition. What does 50B says? Cost of acquisition is the net worth of this undertaking. How do you find out net worth? You have assets in this undertaking minus you have the liabilities. I just showed you the balance sheet. See, so assets of this marketing division minus liabilities of this marketing division. So you will find out the book values of the assets and the liabilities. And you subtract that to find out the net worth of this division. Let us say it comes to 280 crores. This difference is how you compute capital gain. So what is the special point? The special point is this. The cost of acquisition in case of slum sale is the net worth of that entire undertaking. Most important point number 2. It may be long term, it may be short term. How? Depending upon how old is this undertaking. So the undertaking which you have sold is now treated as the asset. This is the most important point. Now we are not going to compute capital gain of the building or the vehicle or the furniture which is sold. We are going to compute capital gain of that entire division, entire undertaking. And if that undertaking is more than 24 months old, we will call it as long term. If it is less than 24 months old, we will call it as short term. So this is what is the special point relating to slum sale. So slum sale means transfer of one or more undertakings. And the most important point, for a lump sum consideration without values being assigned to individual assets or liabilities. The determination of value of assets or liabilities for the sole purpose of stamp duty, etc., etc., shall not be recorded as assignment. Now, what is important? Whether it is long term, short term. So the answer is if the undertaking is held for more than 24 months, then it shall be treated as long term. But if it is held for less than 24 months, it shall be treated as short term. So this 36 months rule has changed. It is now 24 months. Most important point number 2, what is the cost of acquisition? The cost of acquisition is the net worth of the undertaking. So cost of acquisition will be by taking the net worth. What is the full value of consideration? Full value of consideration. Fair market value of the capital asset as on the date of transfer, calculated in the prescribed manner, shall be deemed to be the full value of consideration. So this is what is the special point. So this 500 crores which I have given, it is the FMV as per the rules given. So I have to find out the fair market value as per the rules. This is how you will compute the capital gain on slum sale. Chartered accountant's report will be taken for all these values. How to determine net worth? Net worth will be aggregate value of your assets minus the value of liabilities. Most important, you have to take the value as appearing in books of accounts. If there was any change in the value on account of revaluation, it will not be considered. See, in accounts, we always do revaluation. Income tax never supports revaluation. So if there was any revaluation, that will be ignored. Further, if there are any depreciable assets, then what will happen? In case of depreciable assets, you will take the WDV of the block. So this is how you will find out the net worth by taking the book values of the assets. If it is depreciable asset, you will take the WDV. If it is intangible assets, you will take it nil. If it is assets for which you have already taken 100% deduction like 35 AD asset or scientific research asset, it will be nil. And for all other assets, it will be the book value without considering reconciliation. So this is how students the working happens. Correct? Nagaraja, 36 months was the old rule. So up to last year, the long term, any asset became long term. There was 12 months, 24 months, and 36 months. And slum sale was falling in 36 months. But now the 36 months rule has been removed. So it will be now 12 months. Correct? Fine, students. So this is all about slum sale. So we stop over here. From our next class, we will deal with full value of consideration. Right, students? Which index, beta? Shraddha, you are talking about some index. You said, no, 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 no. I mentioned this earlier also. No need to remember inflation index. No need to remember your telegraphic transfer exchange rates. All these things, if required, would be given. Yes, Dhanlakshmi. See, for SLM asset, there is a very different way of computing capital gains. So you cannot fully say that it is only book value or it is WDV. There is a special method for those assets. One second, I missed the page. One second, one second, one second. Yes. Right? Mustafa, let us not be confused. As I told her also that there is a different way of computing capital gains in case of SLM. Kamlesh, beta, lecture timings are morning 7. We start lecture at morning 7. Correct? Yes, Neeraj. So, see, there are some examples in your module. Definitely, when we will be going with the practicals part, we are going to consider that. But whatever I have covered, please, as a revision, you all go through the provisions again till this page, whatever I have done. Plus, also go through the practical sums. The more you are going through the practical, that will make your concepts clearer. So up till this page, 3.431, where we have covered around 70%, please ensure that you will revise, because as I said, these are interesting provisions, but at the same time, you're learning so many things in one day. So in order that you are able to understand it, retain it, kindly revise it at home. And yes, along with the practicals given over here. Shraddha is asking, sir, can we have another lecture of tax like we had it on Thursday earlier? Uh, so, but it is as per the schedule. Na? Schedule, I think, is already given to you. Mustafa, can you unmute and ask, beta? I'm not able to understand your question. Yes, Dhanalakshmi, cost of acquisition for SLM assets is different. Let us not right now get into that. It will be unnecessary confusing. So I'm keeping that point aside for the time being. Right? Yes, Neeraj. If I remember correctly, the next class is again on Tuesday, not on Thursday. So you have a gap. Kindly use this gap for proper revision. Right? Yes. But a WDV means written down value. But there are two categories, Mustafa. One is the block of assets, where the WDV is as per the block of assets format. The second is power units asset who have opted for SLM. For them, there is a different approach. This is what I'm saying, Mustafa. So WDV means written down value. See, students, again, I'm saying I don't recall the schedule, whether the next class is on Tuesday or Thursday. Whenever it is, we will be connecting on that day, right? So I don't recall, means I'm not referring the schedule immediately. It is not in front of me. Whenever it is, let me just check. Manishji, do you remember when is our next lecture? Somebody saying it is on Tuesday, somebody saying it is on Thursday. See, my schedule says it is on first. That is on Thursday, we have our class. So students, somebody said it is on Tuesday, but it is not. Sorry. Yeah, it is not directly on Tuesday. We have our another class day after tomorrow, that is Thursday. Perfect. Clear, students? So it is on 1st. Nagaraj are not on 6th directly. We have our class on 1st also. Please don't get confused, students. We have our class day after tomorrow, that is Thursday. Fine? Yes, thank you, Shraddha Beda. Okay, students, please revise till this point so that you will be ready to take up things in the next class. Fine? Thank you. Thank you all. Thank you very much. Take care. Best wishes. Thank you all. Thank you, Neeraj. Thank you. Yes, thank you.